Hey guys, today we're jumping into the world of exchange-traded funds, or ETFs for short. Specifically, we'll be focusing on 3 dividend-paying powerhouses that I believe offer the best value for investors at the moment. Most importantly, I'll be providing detailed explanations and numbers to back it up. Now, before we delve into the intricacies of these ETFs, let's immerse ourselves in the fundamental concepts of ETFs as a whole. ETFs, often hailed as the investor's dream, represent a revolutionary marriage of the flexibility of individual stocks and the diversification benefits of a managed fund. At its core, an ETF is a basket of assets, such as stocks, bonds, or commodities that track the performance of an underlying index. Each ETF issues shares that represent an ownership interest in the underlying assets. Think of a box of chocolate. You buy a single box, but inside you could have 10 or more flavors to choose from. It's the same with an ETF, but with company stock. And by having 10 or more stocks, even if one underperforms, there's many more that will hopefully outperform. This is called diversification, which is the first compelling feature of ETFs. By holding a basket of assets that mirror an index, ETFs inherently offer investors exposure to a broad range of securities. This diversification helps mitigate risk compared to investing in individual stocks. For instance, a single ETF tracking the S&P 500 provides exposure to 500 of the largest US companies, spreading risk across different sectors and industries. So why have ETFs become such a powerful tool for investors? One key advantage is their cost effectiveness. ETFs often have lower expense ratios compared to traditional managed funds. This is because ETFs are typically passive in that they simply follow an index, requiring less active management. Lower expenses mean more of your investment returns stay in your pocket. Another is having the ability to freely trade the ETFs on stock exchanges, just like individual stocks. This characteristic brings liquidity to the forefront, allowing investors to buy and sell ETF shares throughout the trading day at market prices. The ease of buying and selling at any time during market hours contrasts with traditional managed funds, which are typically priced and traded at the end of the day. This is less important when we're investing for dividends, however, as only over longer periods of time do we fully benefit from having dividends compound. It is, however, reassuring that we can quickly liquidate our ETFs if a need ever arose. These are going to be some of the main factors that we will be looking at in this video, so let's get right into it. First up, we have the iShares Select Dividend ETF, trading under the ticker DVY on the NASDAQ exchange. Launched on November 3rd, 2003, DVY aims to replicate the performance of the Dow Jones US Select Dividend Index. The ETF's expense ratio of 0.38% underscores its commitment to cost efficiency, allowing investors to retain a significant portion of their returns. As of the most recent data available, DVY also has amassed an impressive $18.3 billion under management, reflecting the significant investor interest in its dividend-centric strategy. This substantial amount under management not only underscores the popularity of DVY, but also speaks to the trust that investors place in the fund's ability to deliver consistent income through its portfolio of dividend-paying stocks. If we look at the fund's stock holdings, we can see a curated selection of companies with a strong track record of paying dividends. The ETF's lack of geographic split is also a major point to note. 100% of the fund's holdings are allocated to US stocks, meaning that by investing in this fund, you won't have any exposure to international stocks. In terms of the industry split, the fund's portfolio is strategically designed to encompass a variety of sectors, each contributing to the overall income-generating potential of the fund. Financial services, utilities, industrials, and consumer goods are among the key industries represented in the fund's holdings. Specifically, these companies include the likes of Verizon, IBM, AT&T, and many, many more. Each company must have a large capitalization, at least 5 years of consistently paying dividends, and of course, be profitable. This balanced industry allocation aims to provide investors with a diversified stream of dividends, offering stability and resilience in various market conditions. By spreading its investments across sectors, this ETF seeks to navigate the complexities of the market, while maintaining its commitment to delivering reliable income to investors. The fund strategy revolves around selecting stocks based on dividend yield, payout consistency, and dividend growth. This meticulous approach ensures that the fund's portfolio consists of companies with a strong track record of returning value to shareholders. The current dividend yield of 3.82% positions DVY as an attractive option for income-focused investors, and its consistent dividend payout history showcases its reliability as a dividend income stream. Investors should be wary of its over-reliance on US shares, however, which could open the fund up to geopolitical risks and missing out on some superior dividend-paying stocks from around the world. That brings us on to our second ETF, the SPDR Portfolio S&P 500 High Dividend ETF. It trades under the ticker SPYD, or SPIDY, on the New York Stock Exchange Arca exchange. Launched on October 21st, 2015, SPIDY is distinct for its focus on high dividend yielding stocks within the S&P 500 index. With a substantial assets under management of $6.7 billion, SPIDY has captured the attention of investors seeking a high dividend yield within the S&P 500. Many investors prefer to invest within the S&P 500 as these represent the 500 largest stocks listed in the United States. Larger companies tend to be less volatile and more profitable, which is preferred by dividend investors as it preserves their wealth while offering more stability to their dividend payout. With $6.8 billion under management, this is no small fund, which reflects the investor confidence in SPIDY's ability to deliver attractive returns amidst the competitive ETF market. Exploring SPIDY's stock holdings reveals a highly crafted portfolio comprising high dividend yielding stocks within the S&P 500 index. The fund predominantly invests in the financial services, real estate and utilities sectors, which tend to be highly profitable and stable. As such, this focus aligns with SPIDY's investment mandate to target companies with a history of distributing higher than average dividends. Like the iShares ETF we covered first in this video, this fund also has strong holdings in the likes of Seagate, Verizon, and IBM. What makes it slightly different is its sector split, where SPIDY has a higher weighting towards the real estate and healthcare sectors, while DVY focused more on the utility and consumer discretionary sectors. By selecting stocks from sectors known for their income-generating potential, SPIDY aims to provide investors with exposure to a diverse range of industries while optimizing for high dividend yields. With an expense ratio of 0.07%, SPIDY remains cost-effective for investors looking to maximize their returns. The current dividend yield of 4.66% positions the ETF as an attractive income-generating option, and its history of stable and competitive dividend distributions solidifies its appeal. And finally, we have made it to the third ETF in this video, the iShares International Select Dividend ETF, trading on the CBOE exchange under the ticker IDV. Launched on June 11, 2007, IDV expands the dividend horizon beyond the US borders, offering exposure to international dividend-paying stocks. The smallest of the three ETFs featured in this video, with $4.2 billion under management, IDV has carved a niche for itself among investors seeking exposure to global dividend-paying stocks. Outside of the US, some countries, like New Zealand, have stocks that pay much higher dividends than the couple of percent that US investors are used to, which can elevate the returns of this ETF. It's potentially for this reason that the fund has attracted billions of dollars from investors interested in the fund's unique strategy, emphasizing the importance of international diversification for income-seeking investors. A closer look at the fund's stock holdings reveals a carefully curated selection of international dividend-paying companies. The fund strategy strategically allocates assets across various sectors, with the majority of it being financials, industrials, materials, and utilities sectors. This sector-specific approach aligns with IDV's mission to capture value in industries known for their global income-generating potential. By selecting stocks from diverse sectors, such as British American Tobacco, Rio Tinto, Spark, and even JB Hi-Fi, this ETF aims to provide investors with exposure to a broad spectrum of industries while optimizing for international dividend yields. Geographically, IDV stands out by allocating a significant portion of its holdings to foreign equities. This intentional geographic diversification is a key feature of this fund, offering investors the opportunity to tap into the income potential of international markets. The inclusion of foreign equities in IDV's holdings contributes to reduced correlation with the US markets, potentially enhancing risk management and providing investors with access to unique global dividend opportunities. The ETF's expense ratio of 0.51% is in line with its commitment to cost efficiency while providing investors with a gateway to global dividend opportunities. With a current dividend yield of 6.49%, IDV stands out for its international dividend prowess and a history of consistent payouts. The compelling nature of dividend ETFs lies not only in their potential for income generation, but also in strategic methodologies employed by their fund managers. The analysis of sector allocations, geographic diversification, and the underlying index provides investors with a comprehensive understanding of how these funds navigate the dynamic landscape of the financial markets. As investors continue to seek ways to optimize their portfolios for income, options investors like the three we just went over will always prove to be aligned with their financial goals and risk tolerance. If you need help managing your stock portfolio, do make sure to check out ShareSite, which can easily track all of your stock and fund investments around the world, and even in different currencies. They have offered my subscribers 4 months free on their annual plan, so make sure you check them out. I hope you enjoyed this video. If you did, please make sure to subscribe to my channel down below to see all my future content in the personal finance and investing space. Do also let me know down below in the comments if there are any other video topics you'd like for me to cover in 2024. Thanks for watching, and I look forward to catching you on the next one. Cheers.